Today we dive into the world of auditing, specifically, the auditing of disbursement and conversion cycle, with an emphasis on inventories and related accounts. Now you might wonder, why is auditing so crucial? It's simple. Auditing provides a clear, unbiased view of a company's financial health, ensuring transparency and trustworthiness in the business world. Now let's take a closer look at the disbursement and conversion cycle. In auditing, this refers to the process where companies transform their resources into goods, services, or cash. It's a critical part of any business operation, and auditing ensures that this cycle runs smoothly and accurately. Our focus today, however, is on the auditing of inventories and related accounts. We'll delve into the intricacies of this process, shedding light on its importance and how it impacts businesses on a larger scale. Welcome to EY Online. Ensure to subscribe to keep up with our informative content. Understanding the disbursement and conversion cycle is vital in auditing. So let's delve into these concepts. Disbursement, in its simplest form, refers to the payment of money from a fund. Imagine you're running a business, and you need to pay your suppliers for the goods they've provided. That's disbursement. It's the outflow of cash or other valuable assets from a person or company to another entity. Now let's talk about the conversion cycle. The conversion cycle, or operating cycle, is the average amount of time required for a business to convert its investments in inventory and other resources back into cash. It's the heartbeat of your business, the rhythm that keeps everything moving. Think of it as a dance. You buy materials, convert them into products, sell these products, and then you get the cash back into your hands. But why are these concepts important in auditing? Well, the disbursement and conversion cycle are critical because they affect a company's cash flow. Auditors need to understand these cycles to assess whether the company is managing its resources effectively. Let's consider a simple example. Suppose you're an auditor reviewing a company that manufactures shoes. You would look at their disbursement cycle to see how they pay their leather suppliers, their labor costs, and other expenses. You'd also examine their conversion cycle to understand how efficiently they're turning raw materials into shoes, and then selling these shoes to get cash back. If the company takes too long to convert its inventory into cash, or if its disbursements are not properly managed, it could signal potential financial difficulties. As an auditor, you would then raise these issues with the company's management for corrective action. Auditing is like being a financial detective. Understanding the disbursement and conversion cycle helps you put together the pieces of the puzzle and see the bigger picture of a company's financial health. Now you have a basic understanding of disbursement and conversion cycle. Inventories play a significant role in a company's financials, hence their audit is crucial. Think of inventories as the backbone of a company's operations. They represent a significant portion of a company's assets, and their valuation directly impacts the company's profitability and financial health. The audit of inventories, therefore, is a critical process that requires meticulous attention and expertise. So what does auditing inventories entail? Well, it's a systematic examination of a company's inventory records and physical count. The goal is to verify the accuracy of the quantities and costs recorded in the accounting system. It involves evaluating the company's inventory counting procedures, inspecting the physical condition of the inventories, and testing the company's cost accounting system. Now, why is an inventory audit important? Here's why. First, it helps to detect and prevent fraud, misappropriation, or errors in inventory records. Second, it ensures that the financial statements present a true and fair view of the company's financial position. This, in turn, builds trust with stakeholders like investors, lenders, and suppliers. However, inventory audits are not without challenges. Auditors often face issues like incomplete or inaccurate records, discrepancies between physical count and accounting records, and inadequate controls over inventory counting procedures. These issues can compromise the reliability of the audit findings. So, how can auditors overcome these challenges? Here's a hint: thorough planning and execution. They need to understand the company's inventory processes and controls, plan their audit procedures accordingly, and conduct detailed tests of inventory records. They should also substantiate their findings with sufficient and appropriate audit evidence. Moreover, they should use professional skepticism, meaning they should not accept everything at face value. They should question inconsistencies, probe for more information, and corroborate their findings. This approach will help them to detect any misstatements or irregularities and ensure the accuracy and reliability of their audit findings. Inventory auditing might seem complex, but with the right knowledge, it becomes manageable. Alongside inventories, related accounts also need auditing. Let's delve into what related accounts are and why they matter in the auditing process. Related accounts refer to those financial accounts that are directly linked to the inventory. They include accounts payable, purchase returns and allowances, and cost of goods sold, among others. These accounts are like pieces of a puzzle that complete the overall financial picture of a company. So why is auditing related accounts important? Well, it's because these accounts can significantly impact a company's financial health. For instance, if accounts payable are not accurately recorded, it can misrepresent a company's liabilities, leading to incorrect financial statements. Therefore, auditing these accounts ensures that they are accurate, complete, and in compliance with the applicable financial reporting framework. Now let's talk about some common challenges in auditing related accounts. One of the major hurdles is the complexity of transactions. The more sophisticated a company's operations, the more complex its transactions. This complexity can make it difficult to trace transactions through the accounting system. Another challenge is the risk of fraud. Unfortunately, related accounts, such as accounts payable, can be manipulated to create a more favorable financial picture. That's why auditors need to be vigilant and use professional skepticism when examining these accounts. So, how can we overcome these challenges? Firstly, using technology can greatly simplify the process. Auditing software can help auditors trace complex transactions, identify anomalies, and even detect potential fraud. Secondly, a thorough understanding of the company's industry, operations, and internal controls is crucial. This knowledge can help auditors anticipate where errors or fraud might occur and tailor their audit procedures accordingly. Lastly, ongoing training and development can help auditors stay current with the latest auditing standards and techniques. This can enhance their ability to effectively audit complex and high-risk accounts. In conclusion, related accounts are an integral part of a company's financial picture. They need to be audited with as much rigor and diligence as inventories. The challenges of auditing related accounts can be daunting, but with the right tools, knowledge, and skills, they can be effectively managed. Auditing related accounts is as crucial as auditing inventories. Knowing the theory is great, but how about some practical tips? Let's dive into some practical tips and best practices for auditing the disbursement and conversion cycle. First up, understand the business and its environment. Know the industry, the entity, its operations, and the system of internal control. This knowledge will help you identify where risks of material misstatement exist and where they're most likely to occur. Next, always plan and perform your audit with professional skepticism. This means questioning the evidence you encounter and not taking things at face value. Remember, the goal of an audit is to provide reasonable assurance, not absolute certainty. Thirdly, exercise judgment in selecting items for testing. Use a risk-based approach to decide which transactions or balances to test. This will help you allocate your resources where they are most needed and can make the most difference. Moving on, remember to corroborate your findings. Always seek third-party evidence to support the assertions made by the company. This could be supplier invoices, bank statements, or external confirmations. Fifth, document everything. This is crucial. Good documentation provides evidence of the auditor's basis for a conclusion about the achievement of the overall objectives. It also helps in planning, performance, and supervision of the audit. Another key tip is to communicate effectively with those charged with governance. This includes timely reporting of significant findings and issues that come to your attention. This helps the entity to take appropriate and timely action to address these issues. Lastly, always remember to review your audit work. This is a vital step to ensure that the audit was performed in accordance with applicable standards, and that the evidence obtained is sufficient and appropriate to support the auditor's conclusion. So, there you have it. These practical tips, when applied effectively, can greatly enhance the effectiveness and efficiency of your audit of the disbursement and conversion cycle. They can help you identify issues early, save time, and provide valuable insights to the entity you're auditing. With these practical tips, you're well equipped to tackle auditing the disbursement and conversion cycle. Auditing disbursement and conversion cycles, including inventories and related accounts, is no small task. We've covered a lot of ground in today's video, and it's crucial to remember these concepts as you navigate the auditing landscape. We dove into the disbursement and conversion cycle, understanding its intricate workings and implications. We ventured into the world of inventory auditing, unraveling its complexities and the importance of a thorough, meticulous approach. We also explored related accounts, emphasizing the need for a comprehensive audit to ensure financial accuracy. Finally, we shared practical tips to enhance your auditing prowess, equipping you with tools to effectively handle disbursement and conversion cycles. Remember, mastering these areas not only strengthens your auditing skills, but also empowers you to contribute to financial transparency and integrity in your field. What are your thoughts on the topics we've discussed? Leave a comment below, and don't forget to like and subscribe to EY Online for more content like this.